Hello and welcome to another episode of the Smaulgld Subscribers Sound Off, where Smaulgld subscribers get a chance to come on the show and talk about their area of expertise. And today, I am delighted to have back on a returning guest, and Rhenf, and today he's going to talk to us about cryptocurrencies. How you doing this morning?
Hello, Lewis. Glad to be back again.
All right, good to have you. And what's on your mind today? What are you planning on telling our listeners or giving them an update on?
Well, I released a post, must have been a month, maybe 3 weeks, a month ago now, on the last of my Bitcoin Kills Banking trilogy. And this was Bitcoin Kills Banking, Redux, exchanges, and then I go on to list 6 different exchange prototypes, which we are now seeing as this link between banking and Bitcoin grows stronger by the day.
All right, well, why don't you just dive right into it? And my job here today is just to interject the questions I may have or I may think that our listeners may have. So take it away, please.
Well, if we start, I start a part of my post with the financial crisis of 2008 going into 2009, and this was I think it was the 2nd of January 2009 that Satoshi released the Bitcoin protocol. And so as Bitcoin had to start from scratch, it had zero value and zero users in the early days, but the first real act of Bitcoin was to try and distribute its currency outside the miners as sole issuers of Bitcoin. So the early days was trying to get as much currency into as many hands of the public as possible, and so try and distribute ownership somewhat. So
before you go on, this is a question a lot of people have, and a criticism a lot of people have about Bitcoin. When they hear you talk about that, they start making references to Ponzi schemes. How do you explain that and refute that inference?
Well, you could describe Bitcoin in its early days as a Ponzi scheme, but the more people that use it, the less it becomes a Ponzi scheme, because it's kind of a shared network, so everybody gains. You can argue that the early adopters gain more than later adopters, which is certainly true, but that's down to their foresight in identifying and investing in a distributed network that enriches everybody. So you can cash out at the top, but once you've dumped to somebody else, and when Bitcoin and Litecoin go up more than down, it's I've called money the bubble that never pops. So it's like a Ponzi scheme that never runs out of gas, if you understand.
That's what the SEC actually uses, your argument as to why at a certain point in not the genesis, but the development of a cryptocurrency, when it becomes decentralized enough, it therefore is not a security issued by a small group of people, and therefore it doesn't take the definition of security because it's so decentralized at that point.
Yeah, well, I discuss a part in the post that the CFTC have declared Bitcoin to be a commodity, and so it's at this stage it's unique, but I think it's unique anyway in that Satoshi disappeared and the development structure is bottom up rather than top down. Every other altcoin, which is by definition an alternative to Bitcoin, right, has a highly centralized leadership team, and most of them are pre-mined, and so they are, in my mind, blatant securities.
Correct, and I think they do take that view. They finally take the view that Ethereum is not, but I might argue it could be. But Litecoin, Bitcoin, they definitely are not run by a single entity. All right, let's move on. Go ahead.
Yeah, sorry. With such an activist leader as Vitalik, I don't understand how you can consider Ethereum anything other than a security. Anyway.
All right,
Yeah,
let's move on from the
yeah.
Ponzi scheme and back into your development of Bitcoin.
So the first real act of scaling Bitcoin was to scale a Bitcoin exchange, but because there was, virtually, well, there wasn't any regulation in the early days because Bitcoin, came out of nowhere. So how do you regulate something you've never come across? So the first exchanges, the first big exchange was Mt. Gox, which I think was launched in July 2010, and that became by far the biggest Bitcoin exchange in the early years, and I think it was trading around 70% of total global volumes of Bitcoin when it crashed in February 2014. So Mt. Gox was the first, but because it was unregulated and it was, I've just read or listened to Peter McCormack's series on Mt. Gox. So there's 6 different interviews with, Mark Capellas and Jed McCaleb, the guys who set up Gox. And, you really get a sense of how fragile and, just off the fly Mt. Gox was in the early days. The fiat, all the fiat accounts were one Chase Manhattan bank account that Jed McCaleb had. So that's how Gox started to get fiat deposits. But anyhow, what Mt. Gox did was allow Bitcoin miners, to convert some of their Bitcoins into fiat, and it allowed the wider investing public to exchange their fiat for Bitcoins. So, as I say in the post, as pissed off and that people might become at Mark Capellas because of Mt. Gox, I don't think Bitcoin would have scaled near anywhere close without it, because it fed speculation, it fed new hodlers, and it fed local Bitcoins. Started in 2012, Bitstamp 2011, I think, Kraken, Coinbase, all these second generation exchanges that are now ruling the roost. They started because of the early success of Mt. Gox in scaling Bitcoin.
Now, might as well hit this topic now, doesn't the concept of an exchange, while it does provide price discovery, doesn't it run interference with the concept of Bitcoin as being a peer-to-peer currency rather than one that needs to trade on an exchange?
Well, the truth is that the fiat system still rules the roost. So, Bitcoin at this stage is being exchanged for fiat because everybody still uses fiat.
Correct.
So, the only real way of getting this Bitcoin currency into the hands of the public at this stage is through exchanges. Now, in future, when we have scaled medium of exchange layers and payment processing layers like the Lightning Network, then we can start to begin to talk about peer-to-peer Bitcoin exchange. But for now, and because we are still trapped in this fiat Ponzi scheme, then this need and this accelerating need for Bitcoins from people holding fiat will be the main driver of Bitcoin for the next few years. For Bitcoin to become a peer-to-peer currency barter system, it first needs to suck out all the fiat money out of the fiat banking system. So this is what I argue we are in the middle of now, and why all these exchanges are being built. It's to allow this slow drain of the fiat system, which mirrors and pumps up Bitcoin at the same time.
But here's a question for you. Yeah. In that process, is it inevitable in your mind that will happen, or there will just be a growth of Bitcoin within the fiat scheme?
Well, I think, that the only guarantee with fiat money is that it gets debased further. I can,
yes.
At this point when I'm going out shopping, I can tell that stuff's going up in price. I can feel it now. It's like the money is melting in my hand. So, you know, there is only a maximum cap of 21 million Bitcoin, and they are only issued at 1,800 a day currently. So, you know, there's a scarcity of Bitcoin compared to fiat, and therefore I think you are going to get more fiat chasing Bitcoin than Bitcoin's chasing fiat.
That's true, but my question is there an ultimate end game to that, or is it just something that's going to take a long period of time at which the value of Bitcoin or Litecoin or any of the other currencies, and I'm not talking about ICOs or tokens, actually just rise in value versus fiat while the fiat system continues to persist?
Well, you know, this depends on the financial crisis that, you know, it happen every few years in the fiat system. So you can consider a financial crash to be a heart attack for the fiat banking system, and then this heart attack sets off. You know, usually you see the scramble to gold and the shooting price up in gold. You know, it's gone from $200 at the start of the millennium to what, $1,300 today.
Right.
So, you know, it's the fiat system is just going to drain value, and this value is going to have to escape to something that will maintain people's purchasing power and savings. So I think, you know, the move is toward store of value assets first, and, you know, the best alternative currencies, I believe, are gold, silver, and Bitcoin and Litecoin.
Okay. And do you see a preference of those four in any pecking order? Not financial advice, but where do you see people pushing their store of value dollars or fiat currencies into first?
It depends on your concept and of the future, really. You know, Plan A is gold and silver and no electricity. Plan B is electricity and Bitcoin and Litecoin. But even in that situation, you know, gold and silver are still going to be scarcer relative to other goods and services. So,
right.
You know, gold and silver will still go up. All I'm interested in is maintaining and enhancing my purchasing power so I can buy stuff with it in the future much
right.
cheaper than now. So, you know, I think gold stores your purchasing power on a physical plane, and Bitcoin stores your purchasing power on a digital plane.
Makes sense.
You know, I've got no problem. I think the future is a combination of the physical and the digital. I don't think, you know, you could argue a catastrophic loss of electricity and internet over the world, but, you know, over the world, I don't think it's that likely. You may have pockets that lose electricity, but,
sure.
You know.
But store of value basically is also insurance against such events. So if, as you say, you have a digital realm that shuts down for whatever reason, then you still have your physical store of value in the gold and the silver.
Yeah, exactly.
All right. Okay, carry on now. I'm sorry.
Yeah. So right. Okay. So at this point, I think we'll start with these distinctions of. I really detailed 6 different prototypes for the exchanges. So you have decentralized exchanges, which I'll get to. Then you have cash apps, for example, Coinbase or Square. Mm-hmm. You have centralized exchanges, which then go into institutional investing. Then you have the derivatives complex, so derivatives exchanges, futures, and possible ETFs. Then we have banking protocols, so we are talking about networks such as Ripple and Stellar Lumens. And I finish off with stable coins, you know, the most notorious of them being Tether.
Right.
So do you want me to begin with decentralized exchanges?
Sure, and explain the difference between decentralized exchanges and something like Coinbase or Mt. Gox.
Yeah, you know, decentralized is, as I put it in my post, it's quite a broad term, but it covers what I consider to be non-KYC AML over-the-counter exchange of fiat money for bitcoins, which does not tie your identity to Bitcoin necessarily. Others consider it to be non-custodial exchanges. So, the most famous of the early decentralized exchanges was really local bitcoins. So local bitcoins allowed you to send direct bank transfers between parties, and then the other party send you the bitcoin. But because this bitcoin was held on the exchange, some don't really consider local bitcoins to be decentralized. But in the early years, I put it in my post that local bitcoins along with Mt. Gox are the two real exchanges that the Bitcoin community should be most grateful for, because local bitcoins allowed many early adopters to take control of the bitcoins quickly and over the counter and without being tied to any identity as a non-KYC AML.
Now, hasn't that changed though with local bitcoins?
That has changed in the last 6 months, and I sympathize with them. I listened to a similar. Well, I listened to an Eric Voorhees interview with.
He's the founder of local bitcoins.
Yeah, right? No. He was the founder of
Shapeshift.
Shapeshift.
Right. Okay.
And he's just had the same problem, you see. So the SEC has said they're going to shut him down unless he does KYC AML, and I would imagine that they've threatened the same to local bitcoin. So, these established exchanges really they're running out of options with regulation at the moment. So I can understand why they've done it. The biggest example I put as a real decentralized exchange in that post is Bisq. So Bisq is a peer-to-peer client that you download and then you open in your desktop. So it allows you in a non-KYC AML manner to exchange, fiat currency pairs for Bitcoin or Bitcoin for Litecoin or whatever. It's it's my envisioning of a DAO, which is a decentralized autonomous organization. So this is a difference between Bisq and Shapeshift, for example, in that Bisq is not a corporation and it doesn't have any owners. It's like a communal project. It's a decentralized autonomous organization. So it's uncensorable basically, and because of this, the securities regulators don't have nobody really to come after, unlike running a corporation like Voorhees is doing with Shapeshift. So this is an interesting area, and this attempted permanent evasion of these, know your customer, anti-money laundering, money transmitting laws that these governments are trying to put on Bitcoin exchanges. The one other.
Let me ask you a quick question about decentralized exchanges without the KYC and the money laundering issues. What percentage of Bitcoin traders do you think are even interested in that? Because when I look at if you buy stocks like Apple with a Charles Schwab account, a Fidelity account, TD Ameritrade account, you're not thinking at all that you want your transaction to be private. You know that you're going to pay taxes at the end of the year. Do you think that the majority of investors, especially institutional investors, will even care about these types of decentralized exchanges where in a sense you could avoid money laundering?
No, they won't. I say it.
I think they actually want it, don't they? They want that regulation.
Well, yeah, this is an illiquid and unregulated market. So it should be clear that Wall Street will never invest in these type of exchanges. That they'll require a different type of exchange, which I'll get to later. Okay. So just the one other quick area that I class as a decentralized exchange, and I know you track these, brick and mortar businesses that sell bitcoins for fiat, and ATMs, so automatic teller machines.
Right.
We've got. So in the future, as I expect Bitcoin to grow, I expect this brick and mortar high street seller to emerge on high streets in towns and cities all over the world, so that they can sell Bitcoin for cash or fiat money. But you know, this is an added benefit in that, you know, an experienced seller will be able to set people who want to hold Bitcoin. And ATMs are the same, you know. I keep a rough track, and I think there's 4,500 ATMs in the world now.
That is correct.
And
Almost 3,000 of them are in the United States.
70% of them are in America. So
that's right.
So you know, if we're talking about 4,000 price discovery points spread around the world, and that's just in one type of exchange. So, you know, if you compare that to the gold exchange with the COMEX and the LBMA and the Shanghai Gold Exchange, that Bitcoin exchanges, even just the decentralized exchanges, which I would say are maybe 10% of Bitcoin or even less.
Mm-hmm.
You know, there are already thousands of price discovery points just in that one small corner of the Bitcoin exchange space.
You know what I don't have any understanding of, and I haven't seen, you know, you can look at Coin Radar and to find a Coin ATM Radar and find out how many crypto ATMs there are and which coins they dispense, but there's no indication that I can find of the aggregate volume of Bitcoin or Litecoin that are bought and sold through ATMs. Have you seen anything along those lines?
No, and I'm not clear, you know, of the steps you have to go through to exchange, you know, the fiat currency for the Bitcoin, whether they ask for any kind of ID or...
Some of them do, some of them don't.
Yeah. So,
and it's dependent on what the local
yeah,
state regulations are and money transmission and so on.
So, you know, I say in my post in another section that, you know, Bitcoin adoption will... Bitcoin will be adopted in different countries depending on how they regulate.
Mm-hmm.
So, if you look at China, for example, where they banned all online exchange, the over-the-counter trading in China has exploded, and the Chinese government is, well, it's going to struggle to track this because, you know, they've banned all regulated exchange. So most of all the exchange are by definition unregulated, and so they can't track or trace where the funds go, which, you know, is pretty short-sighted. Well, depending on which way you want to look at it. Anyway, you know, so the thing about decentralized exchanges are they are more inconvenient and they are more illiquid than, you know, more convenient cash apps and centralized exchanges. So for this reason, you know, the price you pay for privacy is you have to pay a higher premium to procure your Bitcoins. Because it's unregulated, it costs you more. But obviously then you don't have to tie your identity to your Bitcoins. Okay, so the second is cash apps. So we're talking about Robinhood, we are talking about Coinbase, and we are talking about the latest one, which is Square. Mm-hmm. And Square is starting to take quite a share of Bitcoin sales, and it hasn't quite reached the UK yet, but I'll be interested to try it out. I think because I think this is the best, really the most convenient way of owning Bitcoins that I've seen.
I did try it out, just so you know. It's I have the Cash App and I bought $50 worth, and it's pretty easy to do. You link your bank account, you hit buy, and then it shows up in your application, and you can send it out, or you can you can sell it and move it into cash. And the last I heard, they had sold about $168 million worth of Bitcoin over the last 2018, of which it was an increasing amount each quarter. So I think in the final quarter they sold 50 million worth of Bitcoin. Be interesting to see when they report very shortly what they sold in the first quarter of 2019.
Yeah. So you know, you try this experience like Square or Coinbase, and you find just how easy it is to buy Bitcoin in 2019 compared to what it was to buy Bitcoin in 2012, say, when you only had 2 or 3 exchanges. But the
by the way, getting confirmed on the Square app is pretty simple. You take a picture of yourself and you scan your driver's license, you attach your bank account, and then you're off and running.
Yeah, but the trade-off for using cash apps such as Square is that you have to upload your driver's license, you have to link your bank account. So all of a sudden, your identity can be tied to your bitcoins. So, I've heard that Square have got a pretty good privacy policy, so you might want to worry less with Square than you would with Coinbase maybe, but still, it does create the possibility of a honeypot for stealing funds and for IRS shakedowns, as Coinbase users have found. So this is the price you pay for convenience, is that you become subject to governmental and corporate surveillance.
Sure, and that's the same case, though. I argue that if you're going to buy stocks or bonds from Fidelity or Charles Schwab, it's the same issue.
Yeah. So cash apps I consider to be convenient and very user friendly for the retail investor, like decentralized exchanges exist for the retail investor. So now we'll get into centralized exchanges, and we'll start talking about institutional investment, which takes, it could take Bitcoin in a completely different direction.
Okay.
Yeah, so I talk a bit about in my post about how Gemini and Coinbase have got bit licenses. I think Bitstamp has just got another bit license the other day.
That's the New York State license that they grant. Yes,
the banking license, yeah.
Yes, and Bitstamp that's right, just got it. And Bitstamp is I think it's from Slovenia. It has offices in London, and now will be able to operate in New York and the United States, I believe.
Yeah, so this is what I describe as this secular shift of the first generation Bitcoin exchanges from retail to institutional. So, we've already discussed decentralized exchanges and cash apps that exist for the retail investor. Now, I think Coinbase would lose out to Square in the long run, Square and Robinhood and other cash apps that will come. Whereas, if they start, as they have procured these bit licenses and banking licenses, that they are shifting into the institutional investing space, where there is by definition, little if any competition.
Well, let me ask you, why do you think that the Cash App, which only has Bitcoin on it, would manage to outcompete Coinbase, which has now, I think, about more than a half a dozen assets traded, and perhaps more liquidity because you can trade out, and they even have a stable coin, which I suppose the Cash App uses cash as its stable coin. Just briefly tell us why you think that Jack Dorsey's Square has some type of advantage in the retail over Coinbase, because Coinbase just came out also with that credit card.
Yeah, reputation would be the first one. I don't know if you've been tracking what's going on at Coinbase, but for the last 2 or 3 years, it seems that Brian Armstrong has done nothing except annoy people in the Bitcoin space.
Sure, so but Jack Dorsey has annoyed people in the Twitter space. So.
Yeah. But Bitcoiners are generally much more of a respect for Jack Dorsey than they do for Brian Armstrong.
Fair enough.
And all this neutrino business and everything. You must have seen the yes. delete Coinbase hashtag on Twitter.
Yes.
It's all over Twitter. Yes. So I think Coinbase are going to lose a lot of institutional investors, but I'm not sure if they really even care, because I think they've got bigger fish to fry, which is the wolves of Wall Street, as I call it in my post.
Right. Well, there's also Bakkt as well, which probably can outdo Coinbase.
And after discussing that, I came specifically to Bakkt in my post, and I discussed Bakkt in detail because
yes,
it's a physically delivered and stored Bitcoin futures contract. So it's
which is not yet, for our listeners, has not yet been launched.
Yeah, it's still awaiting approval by the SEC, I think. But
I'm not sure that that's the case. I think they're building out something much larger than they had originally, and that's what's delaying it. I think they're probably adding assets. They seem to be making acquisitions and hiring people. that maybe they're going to do something a little bigger than their initial plans. But I could be wrong. We'll see what happens if and when it launches.
I call it the my envisioning of the second generation Bitcoin institutional exchange, in that once this thing is built out and it has all the securities licenses and everything, then it allows Wall Street a regulated method of entering into Bitcoin. And I say in my post that we could be talking trillions between pension funds, mutual funds, stock funds, bond funds, hedge funds. I'll probably get to it later on, but I think that Wall Street will invest into Bitcoin as a store of value asset more than anything else, and it can be used, such as gold, to recapitalize the entire insolvent infrastructure of fiat money, along with gold.
Okay.
Yeah. So where were we now? Just finished with Backed. Do you want to add anything further on Backed? Because I think it's quite an important development. But
well, maybe we could talk right now about if Backed comes online and things develop, and there is and remember, it doesn't take much of an institutional interest for them to gobble up a good portion of the Bitcoin, because the example I like to give is it makes prudent sense. It's not a risk to put 1% of a portfolio, a hedge fund or any other type of fund, into a speculative asset like Bitcoin, because if you lose that amount, the portfolio suffers a 1% loss that presumably can be made up in the rest of the portfolio. However, if it goes up tenfold, you've now made a 10% portfolio gain. If it goes up 100-fold, you've doubled the amount on just the 1% of the entire portfolio on just a 1% investment. And a 1% investment on a few $100 million funds, and there's plenty of those funds, that's a lot of money that can move into the crypto space. But as you mentioned, there's only 18 million or so Bitcoin out there, and really there's only another 3 million left to be mined. You want to talk about that dynamic and how that impacts who holds the bulk of the Bitcoins?
Well, if you don't mind, could we just cover the rest of the exchanges first? Cause
absolutely, but just keep that one in mind, because Backed impacts that particular dynamic.
It does, yeah. So, okay, next section is derivatives exchange. So I discussed futures first, which is cash. The CME and the CBOE, I think they're quitting now, CBOE, but the CME futures have, rocketed this week, and they are not linked, or they do not interact with the underlying Bitcoin, but they are a derivative of the Bitcoin price on any such exchange or combination of exchanges. So, you have commodities futures in oil or gas or electricity or gold or silver. So, the launch of the CM, I think it was the CME or CBOE futures, was that was the high point of Bitcoin in the end of 2017 and the start of the bear market. So I put a section in my post just to wind up some hard money gold bugs that think that the futures launches of Bitcoin futures means the death of Bitcoin, but it's far from that. This correlation is causation. That, well, I saw Turd Ferguson discuss it. He thinks that Bitcoin is now dead because of futures. So, but in my post I discussed the positives of futures in that it allows people who produce Bitcoin to hedge in fiat money, because miners, for example, they work to produce Bitcoins, but they pay their bills nearly exclusively in fiat money. Correct. So they are somewhat of a hybrid. So if they are heavy on Bitcoins, they can afford to put the Bitcoin against the short, and then they can convert into they can stabilize the fiat money fiat money cash flow, basically, by using futures. So, you know, but futures doesn't really do anything with the Bitcoin, and this is what's different about an ETF. So I discuss a section on ETFs, and you know, this CBOE are going for one. You know, Gemini have been rejected. Van Eck has been trying for 2 years. I just listened to an interview with Gabor Gubac, and he's really quite a smart fellow. And
now remember, Van Eck is with CBOE. They're not separate.
Yeah, but you know, I think Van Eck is, from what I've listened to him anyway, you know, Van Eck have got by far the best claim to be granted an ETF. And
there's Bitwise as well.
Yeah, I listened to an interview with a guy from Bitwise last week as well. So you know, that looks another one. So
because they have addressed the issue of what's going on at the exchange, and they identified and they concede that most Bitcoin trading is a scam, but they identified legitimate Bitcoin trading on 10 exchanges.
Yeah, well, you know, the SEC have got this chicken and egg problem that, you know, they decry this Bitcoin volatility, but you know, that's because of liquidity. So right. You know, if you launch an ETF, you get liquidity and you'll get less volatility. But you know, either way, sooner or later, I expect an ETF to be granted by the SEC, and it's that at that time, you know, ETFs are different from futures, and they have to have underlying Bitcoin, you know, for the NAV. So the net asset value must be marked against the physical commodity, which means that, you know, they are going to have to go into the open market and buy Bitcoins.
Right.
Mostly, I would have thought through, you know, exchanges such as Bakkt, but you know, it's fundamentally different from futures in that, you know, Bitcoin comes as like a store of value asset, so you know, it's in their interest to hoard it rather than spend it.
Right.
And if you have, you know, billions or even trillions of dollars entering into the Bitcoin ETF space, and you've only got 21 million coins, well, it's obvious that, you know, the price of Bitcoin's gonna have to go up a lot.
Well, let me ask you a quick question on if the bulk of Bitcoin is used to store and it's not used for its intended purpose as a currency, doesn't its use as a currency, in a sense, give it its value? And if it's not being used, why would you store it?
Well, you store it because it's scarce. It's you know, it's the same with gold. Gold doesn't really scale as a payment system. It scales as a store of value. So you either use silver as a payment system, or, you know, this is the exact reason why banking was invented, to build a payment layer on top of a store of value asset, which really mirrors the Lightning Network, which we'll get onto later.
Okay.
So that's the derivative done with. Now we get to banking protocols, and the one I picked out was Ripple. As you know, it's been around since 2012, and I say that these I find these pretty interesting, actually, in that they are not decentralized as such, but they act more like a decentralized network of exchanges. But they are, you know, they are highly fragile in that if the Fed or whoever, the US government, decide they want to shut Ripple down, it's relatively easy to shut Ripple down. I think they've got a 3 or 4 man person team. You know, they have an office. They are publicly visible. So, you know, if somebody wanted to arrest them or shut Ripple down, it would easily be possible. On the other hand,
is that the same for Stellar Lumens?
Yes, it would be. This is Jed McCaleb's new venture since Mt. Gox. So, on the other hand, if banks decide to work with Ripple, it can weaponize their interbank protocols. You know, it's like 100 times better than SWIFT. So, you know, this is they are in a fragile position. But if these banks decide that they provide them efficiencies and, you know, they cut out many middlemen, then I can see Ripple really going massive in scale, but I would consider it for the short term, because I would also consider Ripple to be a connection between Bitcoin and fiat money, because Ripple allows you to set up gateways with banks, and it allows you to exchange on cryptocurrency exchanges for Bitcoin. Then I envision Ripple as a transitionary layer between fiat money and Bitcoin. So I say in my post that this is a pretty interesting space to keep looking at.
No, I don't want to break the flow of your thoughts, but I do want to get your quick thoughts on those that say that Bitcoin can be shut down, not necessarily by shutting down the internet, but by China, by just stopping or halting or limiting the Bitcoin mining. Do you care to comment on that?
Well, you know, the Bitcoin mining was maybe 70% in China 2 or 3 years ago, but it's not anymore. And you know, this last year of Bitmain, where they tried to fuck off Bcash, and you know, they tried to IPO and they both failed to do that.
Right.
You know, China is basically Bitmain. So if China tells Bitmain get out, Bitmain will get out. So China will just lose its share of Bitcoin mining revenues. That's all it is. I'm not too bothered, to be honest with you. I don't think the posts I wrote 2 years ago, I expected China to become the world leader in Bitcoin, but you know, since SegWit was activated, you know, I think that China were the main stallers on SegWit, and then because they lost that, they just decided we don't want anything further to do with it. So you know, it could be argued that the Chinese government were in some way subsidizing Jihan Wu and Bitmain, but I don't think that's the case anymore. I think they are trying to limit their exposure to Bitcoin so they can print all their shit coins.
Interesting. Okay, carry on.
So the last section is stable coins. We've just had JP Morgan coin, and you have USD Circle with Goldman Sachs backing, apparently. You talked about Coinbase's stable coin. So stable coins are very intriguing constructions. They they span a legal grey area. So you know, the one I concentrate on in the post is Tether, obviously, because it's the first mainstream one, and it's out of Bitfinex, which is a so-called shady exchange out of a tax haven. And I would, you know, they can't get any audits, and I suggest in my post that might be because of the banks on the other side of the ledger. So you know, I think Bitfinex is being used by banks for money laundering. So I think it's the banks that do not want an audit of Tether, so you know, their holdings won't come to light. But you know, because of these audits, there is this constant thing over Tether, whether it's fractional reserved or anything. But you know, to strip it down to its bare bones, it's basically double entry bookkeeping. So you take in deposits of fiat money on one side of the ledger, and on the other side of the ledger you issue your counter currency, which in Bitfinex's case is Tether. So if you get 1 billion of fiat money in holding accounts at Bitfinex, then they print 1 billion's worth of Tether, which is pegged to the dollar, so it'd be 1 billion Tether. But interestingly, this native exchange currency can then traverse the cryptocurrency space. It can be listed on exchanges. So you know, the fiat money is packed with Bitfinex, but the secondary layer effects of Tether can spread, you know, to any exchange really on the internet. So you know, in terms of KYC, AML regulation, you know, it must be at Bitfinex's door. So it kind of mystifies me how regulators have allowed Tether to go on for so long. And I will be really interested to see how transparent JPM coin, and you know, I think that every major exchange in the future will be developing their own stable coin. So I will be exceedingly intrigued to see how stablecoins develop, because Tether was the first, and Tether is by far the most shady, I think, that will come.
Yeah, it will be intriguing to find out what happens with stablecoins. I think they're going to be a bigger part of the ecosystem. A lot of money's gone into them. And I've noticed that the one that Gemini has, Coinbase has, any of the dollar-based US ones, they actually have a much more transparent audit of their cash reserves or their dollar reserves, and they have them in FDIC bank accounts. So I think that more of the trading exchanges will have their own stable coins going forward. There's also stable coins I've seen that are not dollar backed, but they're algorithmically backed to have some type of stable value.
Yeah, it's an interesting space on its own, but you say that these new stable coins are more transparent, so that I would assume means that they cannot travel as far as what Tether has traveled. So I'm not sure if JPM coin can be listed on any other exchange other than JP Morgan exchanges.
But JP Morgan, exactly, that's a different type of coin. That's really meant to settle their other type, not necessarily crypto trades, but all types of trades on the JP Morgan platform. But these other stable coins, I guess, are the same thing. You can sell your Bitcoin on Gemini or on Coinbase and convert it into the US dollar coin.
Yeah.
Now, I'm not sure what the liquidity of that coin is outside of the ecosystems of Gemini and Coinbase. But eventually, I suppose a market could develop for those.
Well, if they are pegged to the dollar and, they can travel, it obviously depends. I think this is a this is a highly gray area.
Right.
Anyway, so, that was my main 6 prototypes for exchanges. So then in my post, I start with discussing, the context now of Bitcoin's last 10 years. So if you look, and you can check this mathematically, Bitcoin has a stable issue rate and, compounding rate and whatever else. So in the first 4 years of Bitcoin, 10.5 million coins were issued. I think from January the 2nd, 2009 to November 2012, 10.5 million coins were issued. So that's half the 21 million cap. Then in the 4 years between November 2012 and July 2016, another 5.25 million coins were issued. Then between 2016 and then May 2020, which is next year, there will be another 625 million coins issued. So in the first 12 years of Bitcoin, or its first 3 halvenings, Bitcoin will have issued around 18.5 million coins, and they are already out of circulation. So, even though I described in detail in my post these different prototypes for present and future exchanges, they will be competing for less than the 3 million coins that are left in Bitcoin's issue schedule. So I discuss that, there are many different estimates, but most people say that around 5 million coins are out of circulation, lost forever. So that leaves us with around 12.5 million Bitcoins. So it's here I describe that, the most important marginal determiner of Bitcoin's future is not, the coins that are issued every day now, but which they'll be less than 3 million by next year, but the 12.5 million coins that are in the hands of people who have bought it in the last 10 years.
Well, let me ask you a question. Comparing that to Litecoin, Litecoin is not as far along in its issue schedule. I think only about 61.3 million have been issued out of the 84 million. Does that make it an attractive Wall Street target, meaning that there are still another close to 23, 24 million coins that can fall into the hands of institutional investors?
It could be. I think, you know, the major advantage of both Bitcoin and Litecoin. Could you mute? The major advantage of Bitcoin and Litecoin is that, you know, they're transparently issued, and you know how many of them are. For example, with Ethereum doesn't even have a currency cap. It just has a stable issue schedule.
Right,
but
right.
You'll never know how many Ethereums are actually issued. So I think, you know, in terms of, we've talked about Bitcoin and Litecoin being store of value assets, I think, you know, the most important thing of that is that their issue schedules are transparent. So anyway, getting back to this 12.5 million coins that have already, you know, are in ownership by somebody. So these 12.5 million coins the people are holding, they have two options of what to do with these coins, because, you know, the only reason we hodl Bitcoin is so we can exchange it in the future at a higher price, hopefully, for well, either fiat money or goods and services. So if you want to convert back into fiat currencies, you will have to connect to an exchange. You will have to go through KYC, AML regulations, definitely, if you want to convert a large portion of Bitcoin into, you know, maybe millions of fiat dollars or pounds or whatever. So that opens you up to money laundering accusation, money transmitting offenses. It opens you up to tax shakedowns. Whereas consuming Bitcoin for goods and services through payment processing layers such as Lightning carries no KYC, AML regulations. It can be done completely anonymously. And so this
Can you discuss the Lightning Network, what the development of it and what's going on with it at the moment?
Okay, so Bitcoin is similar to gold in that even though it's digital, it's a bearer asset, and it's more of a store of value vehicle, at least in its early years. So it doesn't really scale as a payment system, and this is, you know, you could argue was the big failing of gold too, and why banking was invented. So the Lightning Network does really the same to Bitcoin as what banking did to gold, in that it builds a second layer payment and currency system. So, you know, you could consider Bitcoin's base chain to be money, but the Lightning Network is transforming it into currency. So you set up channels between different parties, and then you can peer-to-peer transact. Really, this is off-chain, so it's anonymous, it's instantaneous, and you know, the fees are a small fraction of what it would cost on Bitcoin's main chain. So, you know, the first decade of Bitcoin was for retail investors anyway, it was to hold it as a store of value. But, you know, if they've held 10 years now, you know, it's starting to scale these medium of exchange layers, so they can start transacting peer-to-peer with a Bitcoin instead of converting it out of exchanges.
Well, I have a question. If you transact on the Lightning Network, doesn't the transaction eventually have to be confirmed and put on the blockchain?
Yeah, it does. So, you know,
so what does that do for miners? Does it change anything at all in their role?
Well, you know, they basically don't make as many, they can't make as much money in fees as what they could before if, you know, transactions are being carried on off-chain.
Well, doesn't that mean then there's also less of a need for hash power?
Well, they still get the block reward for another 30 years, remember. So they, you know, they get 12.5 Bitcoins every 10 minutes now as it is, plus they get the fees. So
but look, here's my question. What if
look for Bitcoin to scale, the fees on the base chain are going to have to increase anyway. So maybe you could say a scenario where 90% of transactions happen on Bitcoin off chain,
right?
But still, those 10% of transactions that happen on chain could be worth billions of dollars to miners.
Okay, that was my question. I'm glad you anticipated that. But that would make the transactions quicker that were on the Lightning Network. Would you say, however, that a transaction conducted on blockchain might be more secure?
Oh yeah, for sure, it's more secure. But you could, for example, make 100 off-chain transactions and then convert back to on-chain, and the chain would only count one transaction.
Got it.
So what you've done is you've increased your efficiency using Bitcoin by 100 to 1.
Mm-hmm.
So I understand people who say that Lightning Network will wipe out the miners, but that's not really true. Even after Bitcoin's block reward would come to an end, Bitcoin can never operate without any on-chain transactions.
Right, but wouldn't it be a good thing if the reliance on the miners was reduced?
Yeah, and there are different methods of doing that. There has been talk of proof of work changes soft forks to Bitcoin to maybe rein in the miners, but Bitcoin cannot succeed without the miners either. So it's right. It's a balance.
It's a balance, exactly. Okay.
So yeah, so this is what I say about Lightning Network, is that Lightning Network will be magnitudes more efficient as a way for Bitcoiners to consume their Bitcoins for goods and services than it will be by connecting to exchanges on Bitcoin's base layer and opening up a whole can of worms in the realms of KYC, AML, and money transmitting violations and all that stuff. So I think that the Lightning Network has an inbuilt advantage, and indeed, in my post, I discuss a section where I anticipate that many of these exchanges will have to upgrade to Lightning 2, because we need to remember that at the moment these exchanges are built on Bitcoin's base chain, so they are subject to 10-minute confirmation block times, over an hour for outright confirmation. You have the fees, which are high, astronomically high compared to Lightning, and you have Bitcoin's publicly pseudonymous blockchain, which you can track and trace every transaction in theory. So, if these exchanges upgrade to Lightning, they will be able to carry out completely anonymous transactions between exchanges instantly and for zero fees. So Lightning, any exchange built on Lightning would weaponize its efficiency and fees for the banks and fees for the exchanges. So I think that many of these exchanges will start working with Lightning. And in my post I described that you've heard of this LN trust chain phenomenon, yes, which Hodler began, where Lightning transactions. Well, that Lightning transaction has passed through Jack Dorsey of Square App, and yes, it has passed through Fidelity.
And Jack Dorsey has said that Lightning is coming to the Cash App.
Yeah, so Lightning is going to come to the exchanges too, which is going to be a big, boon and adoption case, and it provides liquidity to the Lightning Network, so we can start scaling this payment processing layer.
Now, let me ask you, why is the development of Lightning on Bitcoin far in excess of the very small development of Lightning for Litecoin? Is that because Litecoin doesn't need it at the moment?
I think it's just because Bitcoin's been adopted by more people than Litecoin. But I've discussed, the post before this one was Bitcoin, Litecoin, Lightning Network, and cross-atomic swaps.
Right.
So once you have a Lightning channel on Litecoin and Bitcoin, then that opens up this cross-atomic swap where you can swap coins between blockchains. And in my opinion, for surveillance and money laundering purposes, being able to traverse two chains with a cross-atomic swap will just be a nightmare for law enforcement and securities regulators and all the other people. So I think that, you know, Lightning is basically a dark web of anonymous transactions, and it should be the nightmare of every securities regulator and law enforcement agency.
Doesn't that run counter to Jack Dorsey and Square? If Jack Dorsey's Square is totally compliant, wouldn't adding the Lightning Network give him difficulty with the regulators?
I discussed this also in, yeah. So I have no idea how regulators are going to try to regulate this area.
Well, it's possible, though. The way they regulate it is that they convince Jack not to implement Lightning on his Square app.
Well, if you listen to, you know, Japanese regulators, for example, have promoted self-regulation for these exchanges, and the CFTC have discussed the same, that they hope that these exchanges will be self-regulatory. So I don't know, but you know, Lightning Network opens up a massive can of worms for regulators and, you know, KYC AML enforcers, because this is just, you know, you'll never know how many transactions happen on the Lightning Network. You know, you can track and trace every transaction on Bitcoin, but every transaction on Lightning you cannot trace.
Correct.
So it's like a dark cloud that could dwarf Bitcoin's on-chain transactions with just off-chain transactions.
Can you briefly, for our listeners, describe the debate between Bcash and the Lightning Network and what the issues were there with the bigger blocks?
You know, Bitcoin cashers think that Bitcoin has to scale as a payment system on-chain, which is impossible. You know, Bitcoin's base layer now does 7 transactions a second, whereas Visa does, I don't know, thousands or millions per second. So to scale Bitcoin's base chain, you would have to destroy its decentralization. You would make the costs of running a node prohibitively expensive. For example, I run a node off my 10-year-old computer, and it's pretty efficient. That's only because of the 1 megabyte block size. So, you know, Bcash can use 32 megabyte blocks at the minute because nobody uses Bcash. But if those 32 megabyte blocks would become full, then it would basically destroy Bitcoin Cash in the propagation times between miners and individual nodes trying to validate transactions themselves. It would just be carnage. So this is the trade-off for Bitcoin having a small block size, is that it's going to have to scale its payment processing and medium of exchange layer off chain.
Right, and that decentralization also helps with security, doesn't it?
Yeah, it does. And you know, if you look at the architecture of the internet, you know, the internet began with the Ethernet, which meant that everything sent had to go through this base chain layer until the internet scaled TCP/IP, which is a layer on top. So TCP/IP allowed that, you know, for you to connect without having to go through the Ethernet.
Right. So Lightning Network is the analog of TCP then.
Yeah, for Bitcoin to scale to, you know, millions or billions of users, it's going to have to do it in layers. It is impossible to do on its base chain.
Yes, I think Elizabeth Stark has a nice video on that where she explains the layered impact.
But you know, Bcashers, they think, well, they you know, I think they are Keynesian in outlook. They are consumerist in outlook. They think about consuming before production.
Right, consumers drive the demand.
Consumers drive the demand, but they don't. Producers drive the demand of Bitcoin. You know, price of Bitcoin goes up because people want to hoard it, not because people want to spend it. You have Visa, you have credit cards, you have all sorts of payment systems at the moment. Fiat money is a far better payment system than Bitcoin, but it's a horrendous store of value. Whereas Bitcoin is a great store of value, but it's a horrendous payment system, at least until we scale the Lightning Network, which will obliterate Visa, PayPal, credit cards, bank transfers, remittances. You know, everything. Lightning Network can do everything 1,000,000 times more convenient than, you know, any fiat payment processor.
Now, what about the user interface of Lightning?
It's, you know, it's still a 1-year-old project, so it hasn't developed yet. There's also this issue of needing to run a Lightning node to be, you know, to be your own in the own custody of your funds. So, you know, I have heard of talk that the full nodes will be on smartphones in the next 2 or 3 years, and once that happens,
What you mean preloaded?
The node will be on your phone, so you will be like a self-custodial Lightning Network user. Instead, if you have a look at these first ones, I just downloaded Blue Wallet 2 or 3 weeks ago, and that's
right.
Custodial. So, you know, you don't really own your private keys, you rent them from Blue Wallet.
Right.
So, you know, but this is in development. I expect a big adoption of Bitcoin on smartphones to begin with, considering the Lightning Network.
Because, you know, the Lightning Network, as much as it's had this explosive growth, is still tiny. It has less than 8,000 nodes.
Yeah, not just that. You know, I discuss in my Lightning post how much of Bitcoin coins will actually be tied up in Lightning channels. I think it'll be a fraction, maybe 1%.
Right.
I think it will go up to a percentage, or maybe 5 to 10% of Bitcoins held in Lightning channels, which would be, you know, 2.1 million Bitcoins.
Mm-hmm.
But because the tendency of Bitcoin is to increase in value, that kind of prompts people to take some of their funds out of Lightning channels and onto the base chain for storage, cold storage.
Right.
So people, you know, I listened to Pierre Rochard and another guy this afternoon, and Pierre Rochard was saying that he thinks that all transactions will be done on Lightning, and you know, the 17.5 million Bitcoins, less the 5 million that are lost, will be pledged in Lightning channels. I think that's nonsense.
I think I'd agree with you on that one.
But you know, in my post I also say that maybe 1% of Bitcoins would be pledged in Lightning channels, but that Lightning channel which holds a 1% would be transacting 99% of Bitcoin's transactions.
Makes sense.
So
yep.
So that this is the leverage that is possible with the Lightning Network.
Okay, what else do we got before we sign off today?
Well, you know, in the conclusion of my post, I say that the first decade of Bitcoin was retail investment in the currency on exchanges, first generation exchanges, as a store of value layer, and that now in Bitcoin's second decade will be institutional investing, hoarding the store of value layer, and then, you know, the first 10 years of Bitcoin hodlers will then be using the Lightning Network as a medium of exchange layer. So I think that the next bull market in currency will be funded by Wall Street looking for a hedge against the destruction of all their fiat currencies, and that it is this bull market in value that will scale the Lightning Network as people start to transact peer-to-peer in bartering for, you know, stuff such as coffee. The Lightning Network allows people to accept Bitcoin far more convenient than getting into Bitcoin through an exchange. So I expect Bitcoin's mass adoption to play out on the medium of exchange layer more than the store of value layer.
Makes sense. All right. Well, thank you very much, and for joining us today. And where can our listeners find you online? So I'll put a link to your blog post, so our listeners can take a look at that on below this BitChute and this YouTube, and it'll also be linked on the Smaulgld.com site.
Yeah, so you can find me at I'm on Twitter. It's more a political than an economist account, which is at ANNRHEFN. And for my writing on Austrian economics, if you go to Rhenf, which is ANNRHEFN.blog. So you should find my work there.
All right. Well, thank you very much for joining us today on the Smaulgld Subscribers Sound Off series, and we look forward to talking to you again.
Thanks, Lewis. I always enjoy my discussions with you.
Likewise. Thanks, everyone.